Stop scrolling for 10 seconds, because this is the part almost everyone misses. What you're watching in gold and silver right now is not market drama. It's the output of a machine built over decades, fed by debt, stabilized by confidence, and forced eventually to reveal the true cost of keeping itself alive. And here's the claim that should make you sit up. When a debt-based monetary system reaches saturation, it can't fix itself by being responsible. It can only buy time by transferring purchasing power out of currency and into whatever the world trusts more than paper. Gold becomes the anchor. Silver becomes the accelerant. And the repricing phase isn't random. It's the predictable next step in a repeating sequence. In the next few minutes, I'm going to do 3 things, and if you stay until the end, you'll see why silver can move in a way that feels impossible once the last stage begins. First, I'm going to show you the 4-stage pattern that keeps repeating across history, the exact sequence that turns normal markets into a metals breakout. Second, I'm going to prove that pattern with 3 different historical systems, so you're not relying on vibes. Third, and this is the part you really need, I'm going to apply the same pattern to right now and then show you the 2 signals people ignore right before silver goes vertical. But before we do any of that, we do the authority check, because urgency without numbers is just theater. By the end of September 2025, total global debt was reported around $347 trillion. That's not a statistic. That's a structural condition. That's the world stacking promises on top of the productive base. Governments, corporations, households, all living inside the same debt architecture. And the IMF, using its own lens, has also described global debt remaining above 235% of world GDP, with hundreds of trillions in total debt depending on the measure. Different measurement frames, same message. The system is swollen. Now, here's the line that matters. When debt grows faster than real productivity, the system eventually loses the ability to pay without either defaulting openly or defaulting silently through debasement. If debasement becomes the hidden policy choice, scarce monetary assets must reprice higher. Not because someone decides, but because the unit of measurement shrinks. That isn't ideology, that's arithmetic. And if you think this is all abstract, look at what the market has already been signaling. Reuters reported gold demand hitting a record 5,002 metric tons in 2025, citing World Gold Council data. Not retail panic, institutional flow. The World Gold Council has also reported central banks adding 1,045 tons of gold in 2024. That's not a meme. That's the most sophisticated actors in the system quietly diversifying away from pure paper claims. Now bring silver into the frame. Industrial silver demand reached a record 680, 5 million ounces in 2024, and the market posted another major deficit, roughly 148, 9 million ounces in 2024 in summaries tied to the World Silver Survey. So ask yourself, what happens when a metal is demanded by industry and demanded by fear at the same time? Hold that thought. We'll come back to it, because that's one of the 2 signals most people don't understand until it's too late. Now look at the price stress confirmation. Reuters reported silver breaking above $120 Oz, while gold pushed above $5,500 Oz in late January 2026. Whatever you believe about the future, that kind of move is not a casual environment. That is a market beginning to price a regime shift. Now, here's the structure. This is the machine, 4 stages, and once you see them, you can't unsee them. Stage 1, credibility is built. People believe in the money. Sometimes it's anchored to metal. Sometimes it's anchored to institutions. But the point is, trust. Stage 2, expansion begins. Credit expands faster than output. Governments promise more. Banks lend more. The system learns it can buy time by pulling demand forward from the future. It feels like prosperity because the future is being consumed in advance. Stage 3, reality arrives. Something breaks. War costs, energy shock, demographic strain, political fracture, or the simplest wall of all, obligations, compounding faster than the tax base can support. Policymakers lose optionality. The public loses trust. The system improvises. Stage 4, money is redefined and collateral reprices, sometimes openly, sometimes quietly. Purchasing power transfers. Risk-free claims aren't risk-free anymore. They're just denominated in the unit being diluted. Gold moves first because it's the reserve anchor. Silver often moves harder because it's smaller, tighter, and emotionally explosive. Once the crowd finally understands the supply reality, that's the pattern. Now we prove it 3 times. Not to entertain you, but to confirm the mechanism. First proof, Rome. Stage 1, credibility. Early Roman coinage, especially the denarius, carried meaningful silver content. Trade worked, taxes worked, money worked because people trusted the unit and the state enforcing it. Stage 2, expansion. Rome's costs grew. armies, borders, politics, administration. And the easiest solution was the oldest trick in finance: reduce the silver content while keeping the same face value. You create more units without creating more real value. Stage 3, crisis. Eventually people notice. And when people notice, they behave rationally. Prices rise. Older high silver coins are hoarded. Barter returns. Confidence cracks. The system tries to stabilize itself by issuing more money, and the very act of doing that accelerates the loss of trust. Stage 4, outcome. Controls, redefinitions, and social stress. Diocletian's reforms and price controls, like the edict on maximum prices, are famous because they show the same reflex you see today. When the unit fails, leaders try to command the symptoms rather than cure the cause. The result is the same. Currency credibility fractures and tangible value dominates. That's the mechanism. Credibility, overissuance, confidence break, forced redefinition. Second proof, Weimar Germany. Stage 1, credibility, a functioning industrial nation with a currency that still had legitimacy. Stage 2, expansion, war finance and post-war obligations. Reparations demanded real value while the political system was fragile. The temptation is always the same: print marks to meet obligations and to avoid immediate pain. Stage 3, crisis. Confidence breaks suddenly, then compounds. Production disruptions, political shocks, accelerating money creation. The fatal ratio appears: less output, more currency. Prices sprint. Savings die. Social trust disintegrates. Stage 4, outcome. Currency death in practice. People flee to foreign currency, hard goods, anything that holds value. Stabilization eventually requires admitting the prior unit failed and re-anchoring credibility through a new system. The wealth transfer is brutal. Savers lose, debtors win, real asset holders survive. Same sequence, different century, same output. Third proof, the United States, Bretton Woods to the 1970s. Stage 1, credibility. Bretton Woods made the dollar convertible into gold at 35 tawas for foreign official holders. The world used dollars because the system had an anchor. Stage 2, expansion. The world needed dollars for trade, but supplying more dollars thinned the gold backing. Add big fiscal pressures and an unwillingness to fully fund commitments through taxes. Claims grew faster than the anchor. Stage 3, crisis. Foreign holders wanted gold. Confidence leaked. In 1971, the U.S. closed the gold window. The Nixon shock. The anchor was removed to protect the system from its own promises. Then the inflationary decade arrived. Oil shocks, wage pressures, and the public learning the unit could melt while numbers in the bank rose. Stage 4, outcome. Metals repriced violently. Gold ran from $35 to over $800 by 1980. Silver, smaller and more speculative, spiked hard. The exact top isn't the lesson. The lesson is the mechanism. Once the anchor breaks and inflation psychology appears, monetary metals become the emergency exit, and silver often behaves like the levered version of that escape. Now, if that pattern has repeated across empires, war economies, and modern reserve currency systems, what does that tell you? It tells you the pattern is not a story, it's a system behavior, and now we apply it to today, step by step. No vibes, no comforting myths, just confirmations. Stage 1 today, the credibility era. After 2008, trust was rebuilt not by returning to constraints, but by expanding faith in central banks and backstops. We can manage cycles, we can stabilize markets, we can print stability. It worked for a while because credibility is a real asset until it's spent. Then the pandemic era and beyond accelerated the precedent. When crisis hits, response size becomes enormous. Balance sheets expand, deficits surge. The system learns that the pain can be delayed. That's stage 1. Stage 2 today, expansion at scale. Global debt reaching the reported $345, $7 trillion neighborhood by late 2025 is not a footnote. It's the environment. And when debt is this large, the entire system becomes hypersensitive to interest costs. Small moves in rates create enormous changes in debt service. That makes true normalization politically poisonous. So the system drifts toward fiscal dominance, monetary policy bending to debt sustainability. And when that happens, the unit becomes the shock absorber. Now look at the behavior of the smartest players. Central banks adding 1,045 tons of gold in 2024. Check. Then look at the broader demand. Record gold demand 5.2 tons in 2025. Verified. These are not conspiracy signals. They are allocation signals. Stage 3 today, loss of control. And here's the retention moment. Listen carefully. Stage 3 does not always start with a single crash. Sometimes it starts with fragmentation, trade friction, sanctions, supply chains rerouting, political polarization, inflation expectations becoming jumpy, people realizing cheap money was a phase, not a right. And then you see it in price. Reuters reporting gold above $5,500 and silver above $120 in January 2026 is a stage 3 symptom. It's the market whispering that the unit is being questioned. Now comes the part that changes everything. Why silver becomes the headline. Silver is not just another metal. It's a hinge between two worlds. In one world, it is monetary. Humans have treated silver as money for thousands of years. When trust fractures, people don't suddenly become rational philosophers. They reach for what has historically held value. In the other world, silver is industrial. It is consumed in electronics, electrification, photovoltaics, medical uses, and infrastructure. And unlike gold, much of silver demand is embedded into processes where substitution is difficult. So silver is a metal that can be demanded by fear and demanded by industry simultaneously. Now put the numbers back in your mind. Record industrial demand at 685 million ounces in 2024, a market deficit around 148, 9 million ounces that year. Here's the first signal most people miss. Persistent deficits are like a slowly tightening valve. Prices can stay suppressed longer than you think, until the moment they can't. And when the can't moment arrives, the move is rarely smooth. It's gaps, it's sudden repricing, it's panic buying of something that looked boring a year earlier. Now, the second signal most people miss, the psychological switch. There is a moment, and it happens fast, when the crowd stops treating silver as an industrial input and starts treating it as monetary oxygen. And when that happens, you're no longer in a normal commodity market. You're in a reflexive trust market. That's stage 4. Stage 4, today, the inevitable outcome. Stage 4 isn't just prices go up. Stage 4 is the public recognition that currency is not a store of value. It's a flow tool. Stage 4 is when people stop asking, is this expensive? And start asking, what is my savings actually worth in real terms? And in stage 4, you tend to see 3 things at once. First, gold leads, because institutions move first. Gold demand records and central bank accumulation are consistent with that. Check. Second, silver amplifies. Smaller market, tighter float. Industrial draw. And once monetary fear joins the party, silver can behave like a compressed spring. Reuters noting silver above $120 alongside gold's explosive run is an example of that amplification behavior. Verified. Third, ratios compress. The gold to silver ratio often acts like a stress gauge. In certain phases, silver closes the gap violently. Even if you never trade a ratio in your life, the concept matters. It tells you when silver is shifting from ignored to essential. Now I want to be very clear. Thumbnails that promise single-digit ratios as a guaranteed outcome and guaranteed timing are selling certainty that markets do not offer. No honest analyst can promise a date on the calendar outcome. But what the machine does allow us to say is this. Once stage 4 fully grips the public mind, overshoots can happen because silver becomes both an escape hatch and an industrial constraint. Overshoots are what reflexive systems do. So what does a huge silver price warning really mean in practical terms? It means the easy phase is over, the phase where you could ignore monetary structure and still assume tomorrow looks like yesterday. It means we are moving into a phase where narratives matter less than balance sheets, and balance sheets matter less than collateral. And it means this. If you wait for the emotional permission to act, you usually act at the worst time, after the repricing has already happened. Now, I'm going to give you the cold checklist again because this is how you keep your brain from being hypnotized by headlines. Credibility era built through backstops and central bank faith. Check. Expansion. Global debt in the hundreds of trillions reported around $345. 7 trillion by late 2025. Verified. Institutional hedging. Central banks adding 1,045 tons of gold in 2024. Check. Demand confirmation. Gold demand at a record 5,002 tons in 2025. Undeniable. Crisis signal. Gold above $5,500 and silver above $120 reported in January 2026. Verified. Silver constraint. Record industrial demand 680. 5 million ounces in 2024. Check. Deficit pressure. About 148. 9 million ounces deficit in 2024 per survey summaries. Undeniable. Now, the important part. What does collapse actually look like in a modern system? Most of the time, it does not look like a single dramatic day. It looks like a series of forced choices: financial repression, stealth devaluation, regulatory pressure, and narrative management. It looks like your purchasing power leaking out through the unit, while asset prices inflate in nominal terms. It looks like people becoming confused because their account balance is higher, but their life is smaller. That is how the system buys time, by hiding settlement inside the unit itself. Gold and silver are not magic. They are not get-rich buttons. They are mirrors. They reflect the credibility of the unit you measure your life in. And silver specifically is a mirror that can crack and scream at the same time, because it can be both consumed and hoarded, both industrial and monetary, both boring and explosive. So here's the practical takeaway, and I'm going to keep it responsible. First, stop thinking in price and start thinking in function. What is this asset for in your life? Stability, volatility exposure, a hedge against currency debasement? If you don't know the function, you'll panic at the first drawdown. Second, understand the machine so you don't become its fuel. The machine feeds on reactive people. Reactive people buy late, sell scared, and donate purchasing power to disciplined participants. Third, be careful with leverage. In repricing phases, volatility isn't a side effect. It's the mechanism. Leverage turns volatility into forced liquidation. And forced liquidation is how people get wiped out even when the thesis was directionally correct. Fourth, think in probabilities and risk management, not certainty. The pattern tells you the regime. It does not promise timing. And now the final warning, the part people hate because it removes comfort. This time is different is the lullaby every late cycle society sings. They say exceptionalism overrides arithmetic. They say modern finance has evolved beyond constraints. They say technology will save us, because innovation feels like an escape hatch from math. Technology can increase productivity. Institutions can delay reckoning. Policy can change the path. But none of that deletes the core equation. If claims compound faster than real value creation, the unit must eventually be adjusted, openly or silently. History screams this across empires and centuries. So if you own gold or silver, the message is not panic. The message is recognize the stage and don't outsource your thinking to headlines. Because the next stage of the pattern, the stage where the public realizes what insiders have been positioning for, is the stage where price moves fastest and mistakes become permanent. If you want the next part, subscribe and watch the follow-up, because I'm going to show you how the machine was built. The debt spiral, the policy trap, the liquidity illusion, and why silver becomes the pressure point when confidence finally breaks. And if you're new to markets, this is education, not personal financial advice. Talk to a qualified professional before making decisions. But whatever you do, do not sleepwalk through a regime change, because the machine doesn't warn twice. Reference notes for your fact-checking, not for voiceover. Global debt around $345. 7T by late 2025, and price moves cited via Reuters. Gold demand large central bank buying via World Gold Council reporting. Silver industrial demand record and deficit summaries via Silver Institute, our World Silver Survey summaries. Retention best practice concepts like early rehooks, pattern interrupts, pacing, and open loops summarized from creator scripting, Traktor retention guides.